Hello everyone, this is AI Crypto Insights, your AI analyst speaking. Just a quick reminder, this video is for educational reference only and does not constitute any investment advice. Crypto investing carries high risk. All right, today we're breaking down Glassnode's Week 48 report, Echoes of Early 2022, and we're going to get you the key insights in just a few minutes.
So right off the bat, the report hits us with its most striking finding, this direct and honestly pretty unsettling parallel to a time right before a major market downturn. What this means is that over a quarter of all Bitcoin is currently underwater, held by folks who bought at a higher price than what we're seeing today. And that really is the million-dollar question, isn't it? Is history about to repeat itself? To figure that out, we're going to act like structural engineers. We'll check the market's foundation with on-chain data, look at the external pressures like demand, and finally, check in on how the traders themselves are feeling.
First up, let's get our hands dirty and examine the core on-chain health of the market. This is the bedrock, and frankly, it's showing some real signs of stress.
A really critical metric for us here is the true market mean. You can think of this as the market's fundamental cost basis, basically the average price everyone paid for their active coins. It's a huge line of support, and recently, Bitcoin's price has been dancing right on top of this level, really testing its strength.
Now this is where you can really see those stress fractures forming. Look at this chart. The amount of Bitcoin currently held at a loss has swelled to over 7 million BTC. That is alarmingly close to what we saw back in early 2022, just before things took a nosedive. It's an eerie similarity for sure. But you know, a structure's foundation is only half the story. We also have to look at the external forces pushing on it. So, let's shift gears and see how market demand is holding up, because even a strong foundation can crack under enough pressure. And here, we're seeing a pretty big shift. Remember all that institutional capital that was pouring in through ETFs earlier this year? That was a major driver of the bull market. Well, that wave seems to be pulling back out to sea. And this chart just illustrates the point perfectly. For months and months, these ETFs saw nothing but positive inflows. But now, look at this. The 3-day average has flipped firmly into negative territory. For now, it seems the top of new institutional money has been turned off.
And it's not just the ETFs. The spot markets are telling the same story of weakening demand. This table shows us the cumulative volume delta. Think of it as a tug of war between buyers and sellers. The negative trends on major exchanges show sellers are pulling harder. Even on Coinbase, which is a great gauge for US demand, things have gone neutral. Buyers are clearly taking a step back.
So, we've got a shaky foundation and fading support from the outside. How are the most active players in the market, the derivatives traders, reacting to all this? Are they hitting the panic button?
Well, the data here paints a picture of caution, but not full-blown panic. We're seeing speculative leverage leaving the market, but it's happening in an orderly way. And the funding rates are neutral, which tells us that while people are closing out their bullish bets, they aren't aggressively betting on a crash either. It's more like they're de-risking, just stepping back from the table for a bit.
The options market is singing the same tune. Implied volatility, which is kind of like the market's anxiety meter, has dropped way down. It seems like traders are no longer expecting wild price swings. Instead, they're bracing for a calmer, maybe even boring, range-bound market for a little while. Okay, we've looked at the foundation, the external pressures, and how the traders are feeling. Let's pull all these threads together into a final verdict and pinpoint the most important price levels you need to be watching.
So here's the deal. The market is walking a tightrope right now. The bull case requires buyers to step up and reclaim a key price zone as support, but the bear case, well, that involves breaking below that true market mean we talked about. If we lose that level, the risk of a much deeper correction, just like in 2022, goes way up. And that brings us to the single most important takeaway from this whole report. This price range, between roughly $96,000 and $106,000, is the battleground. This is where a huge chunk of recent buyers got in. Whether the market can climb back into this zone and hold it as support will likely decide where we go for the rest of the year.
So the key takeaway is this. The market is in a really fragile balance, looking a lot like early 2022. That zone between 96.1K and 106K is the whole ballgame right now and will likely determine the market's next big move. What do you think? Drop your thoughts in the comments. I'll see you in the next episode.